Hello, sir. How are you, sir?
Hello, how are you doing?
I'm pretty good.
Awesome, awesome.
Change this here.
Ready for round three.
Yeah, no, we're just keep
Well,
going.
I just say I'm getting ready for round three. It doesn't matter how long I work on these slides, I'm always working on it right up until the last minute. But I guess I'm not the only one.
Yes, I mean, it's all evolutionary, so that's how it goes.
Hmm. Awesome, awesome.
Is your week starting off okay?
Yeah, it is. It is starting off okay.
Good evening, everyone, and thank you for joining us for our Monday wealth building session. And we are on session number 3 with Mr. Harris here. We are just going all the way in. There was so much information to cover. We just gonna keep on rolling with the good stuff. So, of course, if you have any questions, please feel free to put them into the Q&A. And Mr. Harris, the floor is all yours. So tell us more about that tax mitigation.
All right, all right. So let me just get my last few slides here.
Now you know
Uh,
it's a work in progress. He's still
Yeah,
working.
I'm a work in progress, but we're gonna jump around, but we're gonna get it done. We're gonna get it done. So let me go ahead and share my slides. I'm gonna close this one out. But I do appreciate being invited back for the third time for this. I think it's the fifth time altogether if you
Yes, it's
include my
becoming a regular. You just need to
my
show up.
crowdfunding. Yeah, so yeah, we'll have to figure out how to make me part of the staff or something like that. But
Yeah.
anyway, let's go ahead and share the screen. Um, so again, for those who may not have been here before, my name is Kelvin Harris. My company is Kelstar Consulting. Kelstar is a full service financial consulting, wealth strategy, and wealth advisory firm. The technical term for what I do is something called integrated asset management, which is a fancy term for, I'm gonna be essentially three: a business consultant, a financial consultant, and for those who are in an investment consultant, primarily in real estate, but there may be other things you might want to get into, franchising and stuff like that. Because we just want to make sure every aspect of your wealth building process is singing off of the same sheet of music, so to speak. Um, all right. So again, I will give the required disclaimer. The information in this presentation should not be interpreted as tax, investment, legal, or accounting advice. This material has been prepared for educational purposes only, and it is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisor before engaging in any transaction. And I, for those who are so inclined, I would love to be your advisor. Um, but that's a decision you can make perhaps after this presentation. All right. So with that being said, we're going to move on. I think I talked here about my book on Amazon. I think I covered this. This is basically one part of what I think is going to wind up being a few volumes. But in the first wealth tax mitigation, I've covered what's in the book. Since with the last one, I've covered some things that are be going into the next volumes for the secret strategy of tax and savings, or I should say the secret tax-free savings and investment strategies. So look forward to volume 2 and 3. Here are just some other reference books you can look at that I've kind of pulled from or utilized and just kind of consolidated. Again, and I'm not going to spend too much time on this. If anyone here wants to take a screenshot, this is basically just represents kind of like an overview of the journey I take people on and also the process I help them to understand what are the phases to building wealth. And the important question is that anyone who's interested in building wealth needs to really be able to answer, which primarily is, am I just making a lot of money or am I building wealth? Because those are two distinct things. So as long as you're able to um, follow this path that's on the screen, which is, yes, you need to make money, but you need a strategy to keep it, which is a tax mitigation strategy, which kind of brings us here today. But you also need a strategy to grow it, growing being something that's more sustainable, more measurable, more predictable. We don't necessarily want our retirement funds or things like that to come down to a crapshoot, or we're relying on the whims of the market, which can go up and go down. We want something a little more certain than that. Then, of course, we want to protect our money. Lawsuits, creditors, divorce, what have you. We don't want our hard-earned money to be taken from us with some of these things that unfortunately do happen in life. And then last but not least, we want to be able to transfer that wealth to the next generation, ideally seamlessly, no probate, no gift tax and things like that, or minimal, so that the next generation doesn't have to start from zero like many of us have, or what typically happens. Okay, so here again, I'm going to start with my menu of services. I think we've talked about, here are some of the ones we covered in the previous video. So if you missed this, feel free to go back to the 10K page and watch the other videos that I've done. Today, we're going to cover some of my new favorites. The premium financing, the private placement, the charitable LLC, I'll save that for last, and the monetized installment loan. I'm going to say this because there's going to be a lot of information that we haven't heard today. And I'm going to say this just to kind of set the tone. What I've learned in my 10 plus years, and I have it in the book, I forget how I quoted it exactly, but essentially the statement is there are two systems of money in this country, basically for the educated or the people in the know and the rest of us. So, over my journey, I've kind of stumbled across through things. I'm being quite honest, a lot of this stuff I stumbled across. And when I stumbled across it, I'm like, you gotta be freaking kidding me. Like, how long y'all been doing this stuff? And it's been some time. So it's again, almost every month or two, well, I will say every quarter or so, 2 to 3 months, I'm finding new tools that you know that the wealthy, leverage, or just connected, savvy individual that is open to anybody. It's just not information that's getting out. So again, I'll use that as a kind of a precursor to this. There's going to be a lot of stuff that you're going to hear. You're like, I've never heard of this before, and you probably never would have, unless someone like myself stumbled across it and was willing to provide this information. So this is where we're going. So today we're going to start with premium financing, private placement, charitable LLC, and then something called a monetized installment loan. Now, the ones in white, I have kind of summarized. A lot of these you can kind of, I wanted to focus on the things that if you Google it, if you look for it on TikTok or whatever, you probably won't find it. Most of these other ones you can find. I have some, maybe one or two, like this one you might not find, but you probably can find a 412E3. But these are the ones that I'm not going to even say they're hidden. What's interesting about some of these, they actually have income limits, meaning if you don't have a net worth of X amount of dollars, you can't even utilize them. Now, here's what's important about that. On this call today, many of us will not have the requisite net worth to take advantage of these. But I'm a big believer in, I need to know what my money is doing before I get it. So who's to say 5, 10 years from now, a year from now, you won't be in that categories. So that's why you need to know what you can do with those funds before you even get them, or once you get to that next level, how you can kind of move forward. So, all right, so let's go. So here's what we're covering today. We're going to cover something called premium financing, private placement, monetized installment loan, and the charitable LLC. The charitable LLC is my new favorite solution. But what I'm going to do first, unfortunately, I'm going to have to jump between a couple of different presentations. So I think what I'm going to do first, I'm going to do the premium financing, the private placement, the monetized installment loan, because I have them on a different presentation. And I'm going to come back and do private placement and charitable LLC, because these are actually the last two that I heard about. The premium financing is a type of, it's a, I won't even say it's a type of, it's a strategy utilizing life insurance. The private placement is another strategy utilizing life insurance. So the one point I want to make about that is, and again, both of these require a high net worth. But like they say, success leaves clues. And I want to spend a minute on this because I talk to a lot of people about all sorts of things: insurance, investments, annuities, long-term care, high yield savings. And a lot of us feel some kind of way when it comes to life insurance. And I understand that because I used to be one of those people. But the more I look at it, I'm constantly seeing these very tax-free beneficial products associated with life insurance. And it just makes you wonder, okay, what are they not telling us about this? Why is it that Dave Ramsey and all these other people are saying, well, don't use life insurance for investment? But then when you do the research, or when I did my research, I see these multi-millionaires using it. So there's got to be something there. I've heard a term some time back said, success leaves clues. So I want to take all the emotion out, and I'm just going to explain to you how it works. If you don't want to use it, that's fine. If you do, if you feel like, hey, there's some issue with life insurance, I'm here to tell you a lot of other people don't feel that way. And a lot of those people are wildly successful. So we'll take that for what that is. All right, so let me do this. Let me jump around, and I do apologize. I'm going to jump to my other slide, which was a slide I did for another presentation. But we're going to talk about premium financing and the monetized installment loan. Okay, let me just see here. All right. All right, can everybody hear me? And does everybody see what you should see right now is a blank white screen?
Yes, sir.
So, okay, great. All right, here we go. So, premium financing. What is premium financing? Premium financing is a strategy application, or so it's a way we're going to apply a certain strategy based on some characteristics of the underlying tool. What do people use it for? They use it to accelerate their retirement, or maybe even early retirement. It's a way to create what we call guaranteed lifetime income tax-free. Again, because we're talking about taxes, we can minimize taxes on our business and create generational wealth. And it also has an asset protection aspect to it. The type of client benefits. It leverages the bank's money to enhance returns on your life insurance product. So again, we hear that word, life insurance. Ideal solutions for high net worth, illiquid asset portfolios. What does that mean? So for people who make who have a high net worth, maybe they're asset rich, cash poor, or perhaps they are folks who are high income earners or run a very successful business, and they don't necessarily want to spend thousands of dollars getting the life insurance company they need. Meaning, if I run a $3, $4, $5 million business, government contracting, IT, what have you, I should probably have, somewhere between 15 or $20 million life insurance, just because there's something called insurable need. If you're looking at, what would it mean to my family for me not to be here? Well, that's only going to be 3 or 4 years of the lifestyle I'm providing them. And again, with premium financing, I don't know if I have it in here. A lot of times, I think the minimum, and I'm not going to spend too much time, but you know, I'm I'm um, I'm not going to make the assumption that someone on this call, either now or in the not too distant future, is going to meet this net worth requirement. I want to say it's $5 million net worth. So that's not cash. That's, you could have a couple of properties and a few other things, and it's not too difficult to get to $5 million. I know some folks who were easily able to, when you look at the value of their properties and things like that, they were at $8-9 million. This is pre-COVID. So that's the one of the minimum requirements for here for this product. So again, we'll get into low rates and deductible high value life insurance with the death benefit and potentially long-term care. We'll get into the asset protection. But here's the best way I can help you guys understand the concept. And here's another thing I want to tell you about life insurance. And I'm not trying to make this a life insurance uh, presentation or pitch, but like I said, at some point we have to realize that the where we're being steered away from certain things, because when we look at the successful people, if they're all going this way, but social media, the Susie Ormans, the Dave Ramseys of the world are telling us to go that way, maybe there's an issue there, maybe there's not. But in my opinion, I'm like, tell me everything. Show me the full menu. When I go to the restaurant, I want to see the full menu. Let me pick off the menu. Don't have me come into the restaurant and give me the kiddie menu. I'm not a kid. I need to see the whole menu. So I may not order what's on the menu, but at least I need to know about it. So that's what we're doing today. We might not ever utilize this, but we need to know about it. Somebody or will know uh, will be able to utilize this if they so choose. So again, I want to say the net worth requirement for this is $5 million net worth. And this is how it works. So it's very akin to real estate, and a lot of stuff that I see, a lot of these strategies that use life insurance are. So let's just look at a real estate deal and kind of break it down. So here you have a investor, you have an investment property, nothing too interesting, I mean, out of the norm. With this investment property, the investor is going to go to a hard money lender or someone to borrow the money so that they can, what's going on with my animations? Hold on. They're going to, okay, enter. Where's enter? They're going to borrow the money so that they can do this investment property, because they don't have the money. And they're going to, let's say it's 500, say, and the lender, hard money lender, is going to charge them interest on that. They're going to pay the interest on the money that they borrowed, and then eventually they're going to pay them back the principal, hopefully making profit in the deal. Most people on here, I'm sure, understand that this is a classic fix and flip model. So you got to pay an origination loan. Maybe you're turning 13 to 14% interest. So that's how the hard money lender makes their money. So it's a win-win. The hard money lender makes money off the interest. You get the money you need to do the renovation. And then sometime down the road, you have an investment property that you sell, let's say for 800 or so. You pay the hard money lender back their money. and then minus whatever you paid in origination fees and interest, and boom, you've made a profit. And pretty much in this particular scenario, you really haven't used any of your own money. Okay, so that's how that works. So all we're doing is we're swapping out the player. So instead of an investor, you're a business owner. And instead of a house, it's a financial product, which happens to be a type of life insurance. It could be, I think it'd be a whole life, but a lot of times it's a IUL. Again, if you weren't here for the IUL conversations, there were several through the group. There was a young lady a few weeks before I was on that talked about the IUL. Then I came later as I think of part one and talked about just some specific aspects of the IUL tax-free savings. You never lose money, protected from creditors, protected from lawsuits, things of that nature. So these products, life insurance products, when you look at them through your financial product lens, you really start to see the benefit. But going back to the premium financing scenario, so I have this financial product, and again, let's say it's a 10, 15, $20 million policy or something like that. I'm not really trying to just pay the premiums out of my pocket. I would like to have that big of a policy, but what if there was a way to borrow some money from the bank, from a traditional bank, lend me the money to pay for this very large life insurance policy? Because I don't want to use my hard-earned money to pay for it. Or maybe I'm a high net, I have a lot of assets, but maybe not a lot of cash. Or maybe I do have a lot of cash and I just need to stay liquid for my business. So I'm going to borrow the money. I'm gonna skip through this because it just is. I think this talks about some of the things we talked about before. It grows with the market. You never lose money. You're protected from lawsuits and judgments. So a lot of things that were in my second video that we're just reviewing here. But again, if you look at it from a financial lens, it's starting to look pretty intriguing because there's a lot of benefits that maybe we didn't know about life insurance that might make it make sense for us to look at this as investment. You mean I don't lose money? If I get sued, or whether it's a contractor or a creditor, they can't touch the money in here. That's pretty interesting. It can be tax deductible, which I'm going to show you from the business. So there seems to be a lot of upside. All right, so how does it work? I'm going to skip through this because this was, like I said, I went into a lot of detail on my last event. But again, so let's go back to the scenario. I want to get this 10, 15, $20 million life insurance policy. I don't want to pay the premiums. I'm going to borrow the money to pay the premium. General business loan from the bank. Again, let's say the premium is 500,000 over a couple of years. In some instances, I've seen policies where it's 500,000 a year, but that's okay because I'm borrowing the money. There is an origination fee, and there's an interest rate, usually much smaller. So I'm paying interest on the money that I borrow from the bank that I'm using to fund my life insurance policy. That's going to give me all those characteristics we saw earlier. But in addition, the interest of, so if we take that 5 to 6% on average for our $500,000 policy, I'm paying interest payments. Well, interest payments are tax deductible. So as a savvy business person, I probably could use a few more tax deductions to keep my taxes, low. So I get to write off, or I get a tax deduction for the benefit of the bank paying for my large life insurance policy. I'm going to say that again. I get a tax deduction for the benefit of the bank paying for my life insurance. Kind of hard to find anything wrong with that. So once I see the thumb going up. So once the bank, hopefully you got $5 million. So you can start this. So let's talk and see if we can get you 5 million within the next 18 to 24 months. So I'm doing that for the next 15 years. So every year the bank is paying for my life insurance. I'm just paying the interest on the money that they borrow. But over 15 years, because this is a growth product, I'm getting maybe on average 7% a year tax free. And so in that 15 years, I've written off $400,000 write off tax deduction. So I'm paying less in taxes from my business. Now the money in the policy has gone from let's say the cash value in the policy is now 800,000. So in this case, let's say the bank paid what's 500 divided by 15. My math is not. Let me just let me just lock into this and make sure we we have also take 15 500,000 divided by 15, not 7, 5, 15 Kelvin, divided by 15, basically $33,000. So every month, every year, I borrow 33,000 from the bank. I paid, I paid the interest. I got to write the interest off. But while that money was in the account, it was growing tax free. So at the end of 15 years, I get about 400,000 in business tax deduction over that time, which is, I guess, that 26 times 15. And then, but now the policy value is 800,000 tax free money. So I got a write off of 400,000, but now I have 800,000. But now I just have to pay the bank back their 500, which means now I have $300,000 tax free in this account. And oh, by the way, where do I have the number in here? That's just talks about the lifetime income. But I have 300,000 tax free. Generally, the way this is set up, I don't have to put any more money in. So I have whatever, this 10, 15, $20,000 life insurance policy. Let's just say it's a $10,000 life insurance policy. Now, I have my family is going to get 10,000 plus whatever cash values in there. That year after I pay the bank back, I still have $300,000 sitting inside there that I can access tax free for whatever reason. And that at some point that's going to continue to grow, because even though I'm not putting any money in it, in another probably 6, 7 years, it's going to be back up to the 800 where it was. I'm not putting more money in. The bank's not putting more money in. I don't have any more write-offs, but I already got a pretty decent amount of write-off. So at this point, the policy is on autopilot in terms of generating tax-free income every year, to a point where at some point I'll be able to turn this into an income stream where I'll be able to pull out somewhere in the neighborhood of $100,000 tax free for my lifetime. And it literally, so there's a couple ways to look at it. You didn't pay anything for it. The bank paid for it. You paid interest on the loan, but you got a tax deduction for that. So the question is, how much did you pay for this? Did you pay the $400,000, or was, because that $400,000 was tax deductible, did you make money? It just depends on what your income was. But at the end of the day, this is a way for you to leverage one of these strategies to get a very strong financial product, and without paying the premiums, and get a tax deduction to boot. So I think this is just saying, at the end of, let's say a 20-year, 25-year retirement for my early retirement people. So you were able to accumulate over time $2.5 million. So that's 100,000 for 25 years. $2.5 million, and it costs you $400,000 over a 15-year period, tax deductible money. So that's a pretty awesome strategy if you ask me. All right. So yeah, now this is just saying from the $2.5 million, I guess if we look at the total amount, the kind of the upside of the profit, it's about $20 million. Because let's just round it off and say we've over the course of time with the interest payments and the origination fee, let's say spread over that time, it was about 5 million. So you essentially got $2 million uh, interest. Well, in this case, I think it's a $2 million life insurance policy itself. So you got a $2 million life insurance policy with 2.5 million accessible money in it, and that's going to continue to grow depending on how you use that money. So I'm not really going to go into this that much. This is just kind of an illustration, but I want to just kind of keep it high level. But this is sort of showing you how this all plays out, where you're asking for $500,000, you're paying the interest payments. By the time you pay the interest payments back after 15 years, you still have a little over $300,000 in the policy. That continues to grow. You're not paying any more money. And then at the end of that, you have about, just shy of, you have about 800,000 when you start taking your $100,000 a year, and that money just continues to go for like the next 25 years. And oh, by the way, yeah, you started with a $2 million policy, and and then that at the peak of it, it was $2.5 million, but it starts to grow back once you allow these funds to accumulate. All right, so that is the premium finance. So we're going to stop at the end of the monetized installment loan. I'm going to jump back to the other one because we only really have 4 that we want to go over tonight. And I want to, yeah, Tracy, yeah. You don't have, yep, let's talk about getting you that 5 million net worth. All right, so again, that was one of the strategies utilizing life insurance. So the takeaway here is for my high income earners or people, who are on their way, business folks, maybe you're doing stuff online, Amazon, SB, any number of trading. It's not real estate, multifamily. It's not going to be long before you're at that $5 million net worth. So now we can start playing in these fields where others are playing, where we can really start to leverage this stuff for our benefit. All right, so let's go into the monetized installment loan, or sometimes you hear it called the monetized installment sale, or the M453 if you want to look it up in the IRS tax code. Anytime you see some letters and a bunch of numbers, it's IRS related. Now, the monetized installment loan, this is one of those things when I first saw it, I was like, yeah, there's a problem because it's folks doing stuff out here that we had no clue. Again, something I stumbled across. And it's like, it's so, potentially beneficial. Now, this one you don't have a limit on, you don't have to have a certain amount of money. You just have to be in the know. All right, so what is a monetized installment loan? It is another strategy, or what is a strategy application? It's a way to defer your capital gains tax on real estate or selling a business or any large asset for 30 years. I'm going to say it again. Capital gains, the thing everybody is talking about, complaining about. I sell a property. I do a fix and flip. I go on Facebook and say, hey, look at the money I made on this flip. That's not your money if you haven't paid the capital gains on it. Now you can do the 1031 exchange and all that. I don't like the 1031 exchange primarily because I know about this. 1031 is doesn't give you a lot of time. Purchase, business, and acquisition. Actually, the way I stumbled across this, there was a group that I was working with where or a business partner who had a client. Their client owned a FedEx Kinko's combined franchise, and they were selling that franchise for $3 million. And they came to us and said, "Hey, have you heard about this monetized installment loan thing? We think we want to do this." We're like, "No, we haven't, but let us research it." And that's why we're here today. All right, so it's a 1031 exchange alternative. Not going to get too much in that but my real estate folks, again, this is what they pitched to us in terms of, hey, take your money from proceeds from the real estate. If you don't want to pay taxes in, take that money and put it into another property. Has to be a little bit bigger, or some of those rules, and then do it again. But at no time, you're kind of kicking the can down the road. But the question becomes, when do I get to use the money, the assets that I've accumulated through these fix and flips? If you follow the 1031 exchange, it'll be some time because you got to take that money, buy another property, build that up, flip it, buy a bigger property. So again, you're delaying the inevitable doing the 1031 because at some point you're going to either not want to do a 1031, or you're going to attempt to do a 1031 like a few folks I've consulted with, and run out of time because they don't give you a lot of time to get that done. Okay, and it also is a part of a wealth creation strategy. So again, monetize installment sale M453. How does it work? Okay, here is a seller of a property. Let's say it's a small office building, commercial real estate. I don't know if I have any commercial realtors on here. Small apartment building. Here are the buyers. Let's say it's a group, a conglomerate, whoever it is. All right. We're talking about monetized installment sale. Now, of course, the seller could sell this asset to these buyers, make a big fat check, and pay capital gains on that. But again, this guy's in the know. He's like, not trying to do that. What he needs to do is find a qualified intermediary. These qualified intermediaries are typically law firms. And you can research them, find out, hey, how many of these have you done, so forth and so on. But these guys they have to be vetted and approved by the federal government, because this is a kind of a tax related strategy. So they want to make sure these folks know what they're doing. So what you do in this process is let me back up, is that you sell, quote unquote, the asset to the qualified intermediary. So you sell it to the qualified intermediary. What you get on behalf of that is a note. So think of it as the ultimate owner financing. We've all heard about, hey, owner financing. If you can't go get all the money, go to the owner and say, hey, I'll pay you X amount. Can you give me a note for the rest? Well, in this case, the whole 2-3 million, however it is, it's a note. So the qualified intermediary has issued a note where they owe you X amount of dollars for this asset. And that's again why they need to be qualified, because this has a couple moving parts. Now the qualified intermediary sells it to the buyer, the eventual buyers, and the eventual buyers provide the intermediary with the money. So they have the asset, qualified intermediary has the money. You have a note saying that the qualified intermediary owes you this money. So you don't have any cash. I think some of y'all might have already picked up where we're going with this. If I don't have any cash, if I don't have any income, guess what else I don't have? I don't have income tax. But at this point, I don't have any money either, so I'm not necessarily happy. But let's see how this plays out. So next, what happens is the qualified intermediary goes to a bank of their choice and sets up an escrow account. And through setting up that escrow account where that money goes, let's say it was $3 million or whatever, they go to the bank and say, we need to establish a loan for 95% of the sale price paid to the seller. Why is it 95% of the sales price? Because the qualified intermediary has to get a fee. So you basically got to give up 5% so that you don't have to pay 25, 30% or whatever it is on your capital gains. So they go to the bank and say, we need to set up a loan to the seller, but it's a secured loan. Why? Because we set up an escrow account with all the money is already in the account. So Mr. or Mrs. Banker, I need you to loan this seller, let's say, what's 95% of $3 million? So 2.8 something million dollars as a loan. 3 million times 0.95, yeah, $2.85 million. Please give that to the seller as a loan. What do we know about loans? You don't pay taxes on loans. So the seller has most of his money and he's not paying any taxes on it. The bank has access to the escrow, so they know the loan payments for the loan is coming from the qualified intermediary. And they know they can make the money because all the money is already in escrow. So you go to the bank, say, we just set up an escrow account in your bank for $3 million. And we need you to loan the seller 2.85 million. And we're going to make the interest payment from this $3 million escrow that we've already put into your bank. Is that okay with you, Miss or Mrs. Banker? Most bankers are like, yes, it is, because we know you're not going to default on the loan. We can see the money. And oh, by the way, it's in the escrow account. So everybody really gets taken care of, but by doing it that way, all the funds, let me back up, all the funds in this trend of that 2.8 are 100% tax free. Now, let me talk about a couple other things that I don't have illustrated here. In the language, and I'm gonna pause here in a second. A couple other things are happening. So yeah, this person has a loan, but the way the contract is written, that you are not liable for the loan. I'm blanking on the terminology. It's not indemnity. It's hopefully it'll come to me later. But long story short, the qualified intermediary is the one responsible for paying the loan back. You're not required, or you don't have a stake in that. So you're basically free from that obligation. So you get, because essentially you've paid them to take care of this for you. So if for whatever reason the qualified intermediary uses some of the money in escrow and that can't be paid, you're protected from that. I'll get that terminology here in a minute. So that's one of the other aspects, because we don't want this to come back to bite you. So that essentially is the monetized installment loan or monetized installment sale process. I will just say this. This happens all of the time for large transactions. We're talking about when these people are doing these deals for 10, 20, 30, 40, $50 million or more. I think the lowest that I think really makes sense is if, let's say you're flipping a property for $2 or $3 million. So you have an asset that you're selling and you're going to get a lump sum right around that $2-3 million range. This monetized installment sale makes a lot of sense, simply because you're going to be getting a large sum of money that you will not have to pay taxes on. So let me stop there and see if there are any questions or comments regarding those two as I flip back on this side. So again, questions on, where's my
I have a
questions on
question for you,
monetized
sir.
installment sale or the premium financing?
With that installment, where does the installment portion reside? So is it because you have sold it to the intermediary? Is that the installment, or is it because they've paid, the escrow is being paid the interest in that escrow account is being paid?
That's the installment. Yeah, a
Okay,
monetized installment loan. So the loan has been monetized by the installment payments from the escrow. So you
got
get the money
it.
and the intermediary is responsible for making the payments because they got the money from the buyer.
Okay.
Yeah, so that's where the monetized installment, the terminology comes from when we talk about monetized installment sale or monetized installment loan.
Any of you ladies have any questions?
All right. If we have no questions, let's move on to. Oh, let me go. Let me back up because I want to save chat about LLC for last. Some of you may remember when I talked about, here we go, private placement. When I talked about the Private Family Foundation, I think I covered that in the first presentation. But my new favorite, well, Private Family Foundation is one of my favorites, and it used to be my favorite. Chattable LLC is by far my next favorite, my new favorite, I should say. Okay. All right. So let's talk about another strategy used by the super wealthy, but then also just the wealthy, or I think it can be utilized by some of us. When I first heard about this literally had a net worth limit or requirement of $20 million, meaning this is a life insurance product now, meaning they won't even talk to you about this unless you have a net worth of $20 million. So that eliminates quite a few people. However, recently now I'm seeing groups who are doing it for people who have a net worth of 5 million. So there's that 5 million again. But that's something that we can get to. That's attainable, depending on what you're doing and just working with someone like myself who is a wealth strategist to put us on a path of doing certain things to get us to that level. So what is private placement? So I'll give you the verbiage, and then again, I'll do it illustrated. Private placement life insurance is a special form of variable universal life designed for a high net worth individual. So I told you 5 to 20 million. It combines the tax benefits of life insurance. What are the tax benefits of life insurance? Well, primarily is any amount of money that you can grow inside the cash value in your life insurance policy is non-taxable. The question is, what vehicle are you using to grow? Are you getting a flat rate from your insurance company, like 3 or 4%, 3 to 5%? Are you using an index, which would be an index universal life, where your money is based on the market, but not in the market? They look at what the market does and they give you a credit. So you can make money, but you never lose money. We talked about IUL last time. Or are you using a variable where your money is actually invested in the market and is taking the ups and downs? But since we know traditionally the S&P and most of these market trends upwards, you anticipating having a lot of money on the back end. That's essentially what a variable is. So again, it combines life insurance with a customized investment option. It's for a high investment. So often there's the least you can invest is $1 million. It takes advantage of the tax-free growth of life insurance and the potential tax-free distribution flexible investment, including alternative assets, requires substantial wealth to qualify, 5 to 20 million. All right, so let's talk about how life insurance works, and then I'm going to show you how private placement life insurance works, because they all really work the same. This is why I talk so much about life insurance. I'm sure some of you, why does dude talk about life insurance all the time? Because it's one of the few products that if you understand how to use it, you can grow as much money as you want tax free. But that's what Dave Ramsey's not telling us. That's what Susie Orman's not telling us. They're talking about term policy. They're talking about whole life. They're talking about, talk to me about what the wealthiest 1% are using life insurance for. Then let me decide if I want to use it or not. So that's what I'm talking to you about today. All right, how does it work? Now, this is all what we call permanent life insurance, or all cash value life insurance. This is not applicable to term. This is not applicable to accidental death. This is not applicable to final expense, or what we call burial insurance. In other words, this is not applicable to the type of insurance that they push to our community. None of them work like what I'm getting ready to show you. That's a conversation for a different day. All right, so how does it work? It works sort of like a cup. This is all cash value life insurance. What does that mean? So you have a cup, you want to get something to drink. There's probably a minimum amount that you're going to drink, that you're even going to bother yourself to go to the cabinet and pull a cup out. That minimum amount is what we call the minimum premium. From that minimum payment, part of that money goes to the cost of insurance. So the insurance company gets that. This is an insurance company building. Cost of insurance. So this is somewhere between 25 to maybe 45%, depending on age, health, that sort of stuff. So of this minimum amount, they get the smaller cut generally. Sometimes if you have other ailments, it might be a bigger cut because you're a bigger risk, but 9 times out of 10, it's a much smaller cut. So the rest of that premium goes to your cash value. And inside that cash value, think of it like a vault where your money grows, and it's kind of like a high yield savings. So again, this money could be growing at 6, 7, 8, 9, 10% rate of return. 67% of your minimum amount is growing here, and that is growing 100% tax free. This is all cash value life insurance, whole life, universal life, index universal life, variable universal life, and premium financing is just a variation of variable universal life, and I'll break all those down in a minute. But I just want you to understand the concept. So when you're paying your premium, and people say, "Oh, this whole life policy, this IUL, is so much higher than my term." Well, yeah, it is higher, because the insurance company is probably getting close, about the same amount when you break it down in terms of your lifetime. But what people don't understand, that extra money you're paying is actually going to you, or that extra money you're paying or is going into the equivalent of a high yield savings for you. So when you're saying, "Oh, my premium is too high for that," what you're really saying, and maybe you're not knowing, is I don't want to pay myself all this money, this additional money, so that it can go tax free for me. That's what you're, because that's where the extra money is going. It's going to you. All right. So now, all right. So we only are here at the minimum. So we got, we got a lot of room in the cup. So then we got a lot of room in the cup. So that's when we get back to our analogy where we say, okay, every cup has a maximum. It doesn't matter how much you pour in here. It's only going to hold so much. This maximum, or what is called the 7-pay, this is set by the IRS, because the IRS knows that eventually people are going to start figuring out what I'm getting ready to tell you, which is, well, if I do something called What if I put more money into the policy than the insurance company is worried about? Because they just want their cut. Anything you do after that, they don't really care. But if I put more money into the policy, or what we call overfunded, meaning this is what I need, but what if I put over this number? What happens to this money? Now I can't put any more in here because it's not going to fit. But if I go up to the maximum, well, what happens to this? Does some of it go to the insurance? Like what happened? Well, the answer is all of this extra money goes into your cash value inside the account or your high yield savings. So, in other words, this is a workaround of how to get money to grow tax free, because whatever your cost of insurance was for this amount, it's not going to change if you put more in. So, the overfunding is really force feeding. It's a way to put more money into the tax free, the high interest rate tax free part of your life insurance policy, and all it grows inside the policy. And I got this vault here because, like we mentioned before, this money is extremely safe. You're not going to lose any money if the market downturns. Somebody sues you in probably 48 of the 50 states, they can't touch this money. You get a divorce as long as your spouse, well, even if your spouse is the beneficiary, because you change the beneficiary at any time, they can't get this money from you. If in Los Angeles they can, but in most other states they cannot. So creditors can come after you. You got $1 million in there. There's nothing they can do. So a lot of real good aspects of life insurance that we're really not told about. But in this case, I just want a place where I can grow a lot of my money and not have to pay taxes on it. IRAs, taxable. Annuities, taxable. 401ks, taxable. Stocks, everything, real estate's taxable. Is there any place I could put my money where I don't have to come see the IRS every time? Life insurance is one. Okay. But this is just how the basics, and this just talks about, you don't have to fill it up. It's just if you want to, you can put any amount of money over that, and that's how it works. Now, let's get into private placement, because we're going to wrap this up here in a minute. And we're going to go into the final one. So when you're talking about an IUL, that works like this. The question is, the money that goes in here, and we're getting that 7, 8, 9%. How is the insurance company getting me that return? I'm glad it's tax free. I'm excited about that, but I just want to know how y'all doing. Well, returns are based on the stock market or the indices. What's the indice? S&P 500, NASDAQ, Dow Jones. Those are all indices. And there are hundreds of other ones. Some of you have heard of, some of you heard of, some of you haven't. The index has an aspect of a floor and a ceiling, meaning if the market goes down, I never go below zero. But if the market goes up, I will get as much as 13%. So if the market goes up 20%, I get 13. The insurance company gets the other 7. But if the market goes down 20%, I stay where I am. The insurance company, you got to eat that 20%. Don't touch my money. That's where the never lose money comes from. Now, a variable universal life, or VUL, same thing, except for the money, your funds are invested directly into the mutual funds. So they take your money, they buy mutual funds with it. This is the money that goes into this vault, because the insurance company is investing it on your behalf. They actually go out and buy some mutual funds. So we know what happens with mutual funds. Sometimes they go up, sometimes they go down. So with the VUL, there's no floor, but there's no ceiling either. So in that example, if the market goes up 20%, I get 20%. But if the market goes down 20%, I lose 20%. Just like in your 401k, just like in your IRA. So I could lose here, but I could also win big, or I could lose big, or I could break even, or a little bit better than break even. So again, nothing wrong with variable universal life. Just understand how it's being invested. So this is a little bit more risky, so you need to understand that. All right, so again, what is private placement? Private placement is a sort of variable universal life, meaning how are the funds that I'm putting in my high yield savings vault, how are they being invested? Well, those funds are being invested by a designated fund manager in alternative investments like real estate. Okay, Kelvin, what are you saying? What I'm saying is you could have a life insurance policy that's investing in real estate through a fund. So imagine you had a private placement life insurance and you have a fund manager and they're investing in different funds, and one of those funds is BlackRock. How much money you think you're going to make investing in BlackRock, seeing that they're pretty much buying up the planet? You're probably going to get a pretty decent return. And again, what's great about private placement is that return is secured by hard assets like real estate. But again, there's no floor and there's no ceiling on your returns, so there's some risk. But a couple things: you get to pick the fund manager. The person who is managing is not somebody that's assigned by the insurance company. You get to pick the person. So you do your research and, hey, this fund manager, he's getting 20-30% rate of return for his people because he's investing in these things. Hey, I want you to manage my private placement. You can't tell them what to invest in because there has to be that separation, but you can pick the fund manager. Now, instead of with the IUL, instead of getting 7, 8, 9, 10% tax-free return, what if you're getting 10, 15, 20% tax-free return on your money? Because again, it's just an investment with an insurance wrapper, because the insurance is what gives it its tax-free aspect. So again, the tax-free rate on average is somewhere between 6 to 12%, much more than like a whole life or a regular universal life. So this is private placement life insurance. Again, this is where the big boys or the big girls are playing, because like I said, most of the private placement folks, if you go to them, they're going to first thing ask you, do you have $20 million in assets? If you do not, they're like, sorry, we can't help. But again, I do know some organizations that will work with people with $5 million in assets, but that's about as low as we're going to go, because it's high risk, high reward. But again, I would rather about what it is, even if you don't use it, because at some point in time, we're all anticipating potentially being in this area. And that's when you need to know, when you're making more money, where can I go to have my money make me more money in a tax-free environment? So again, with people who are in the 10, 15, 12 million, I have a potential client right now from California. He makes $20 million. So where does he go? IRA is not going to help him. That's what, $7,000 a year max, $7,500 if you're over 50 or something like that. Roth IRA is still not going to help. That's $6,500 or something. He needs somewhere to put his money where that large sum that he make is going to make more money, but it's going to make it for him in a tax-free environment. All right, so that's private placement. And as we're about to wrap up here, let me just go to how much time do I have?
You can go. You can continue to go
Okay.
on.
Okay. Yeah, I know. I think we typically end at 8, 6 to 8, 7:30.
It's truly from 6 to 7, but since you are going on,
Oh, okay.
you
Well,
kind of keep on
I'm
rolling.
sorry. Yeah,
That's
no, we got
that's
one
fine.
more. I'm sorry. Y'all should have. I
We give you
elaborate a little
extra.
bit.
See, this is the perk of being with the 10K. You get
Oh,
extra
I
perks.
get some extra time.
Yeah.
Yeah. All right. All right. All right. So let's go to the last one, which is the charitable LLC. My new favorite strategy. So let me go here. Charitable LLC. I just like the sound of it. So again, let me say this. We've kind of already talked about these hidden aspects of life insurance that the wealthy are using that nobody's talking to us about. But the other component that's in that category are charities or charitable entities. Because why would you think a charitable entity is going to make you a lot of money? So it's almost like this stuff is hidden in plain sight. I'm not going to get into conspiracy thing because I mean the information is there. It's just not that easy to find. But when you really start studying things like trust, charities, life insurance, things that most people are like, yeah, that's I don't. What's that got to do with building wealth? You find out it has a lot to do with building wealth. I'm sorry. Let me just tell. I'll call it back. All right. My new favorite financial solution, the charitable LLC. What is it and what is its advantages? It has a substantial income tax deduction, eliminate capital gains tax on the sale of an asset. There are no or limited taxes on investment earnings, no estate tax, no gift tax. Assets are creditor proof. Now, this doesn't use a life insurance policy, surprisingly enough. Donors retain complete unrestricted control of the asset. Donors can receive tax-free income from the LLC. All right, so is this, yeah, I just put two of these slides together. All right, so here we go. We're gonna wrap this up. All right, so we have a business and now we have an owner. And this business is a single member LLC. Let's say it's some sort of environmental business. That's what it looks like anyway. All right, so this single member LLC environmental business somehow or another gets some proceeds. They win a contract, they negotiate a deal, they sell some land, they sell some property, whatever it is. And now they have received $2 million. Now, maybe this was an entity that was set up. I'm just setting up this thing. Maybe this was an entity that was set up just for this particular deal. So you get a big lump sum. And I think this is where it works the best. And then maybe we're not really doing much else with this entity, or there's no immediate plans for this entity. Meaning I'm not generating this revenue ongoing. I could be, but it's a little bit simpler if you have like you have a situation where a large lump sum because money is coming in, and then maybe not too much else is happening after that. So I got this $2 million here, and we're already in that 40-50% tax bracket or more. But this person is pretty savvy, or they met with someone like me that introduced them to the charitable LLC. So the next thing is we need to modify this entity into a multi-member LLC. Anyone who set up an LLC knows that's not all that difficult, just some paperwork. So I went from a a single member LLC to a multi-member LLC, where the managing partner is one of the members, but the second member is a reputable charity. March of Dimes, Salvation Army, Southern Baptist, whatever, your church that you've been going to since you were 3, 4 years old, reputable charity. Probably not the nonprofit that your cousin set up last year. Okay? Because they're going to look at that charity and see, oh, is this like, and not to say that your cousin's charity is not a real charity, it's just, it may need to stay around a few more years before it's considered reputable. So that's what you want to do. Now, in this membership, in the documents for this entity, what we're saying is that the charity is the owner of 99% of the ownership units. So think of stocks like in a regular corporation, but because it's an LLC or a S corp or something like that, we're looking at units because units are, stock prices go up and down. Units are kind of more defined. So you'll know if I have 99% ownership of the units, I own 99% of the company versus stocks because they may, extend more stock and things like that. So the math can get a little tricky. But here, the math is simple. 99% of the units are donated to the charity. So that means the charity owns 99% of the business. But they own the units. That's what was donated. Now, the units have a value because of the value of the company, but the units of the business and the cash in the business are two different things. The managing partner owns 1% of the units. Okay. But the benefit of being the managing partner is, so that's the managing partner's little piece of the business. The charity owns the rest. So first thing that happens in this scenario, just by making this a multi-member LLC and the charity owning 99% of the units, 99% of this $2 million is instantly tax-free. So 99% of this $2 million is instantly tax-free. Why? Because it's a majority charity-owned entity because you created it through this multi-member LLC. Okay, so that's great. So now everybody, okay, Kelvin, yeah, but what happened with the money? I'm so glad you asked. So another interesting thing about being the managing partner is that all the cash that remains in the charitable LLC is under the control of the managing partner. That's why you're the managing partner. Who's going to manage it? The charity? They don't know anything about how you got this money. They're just a charity. So that $2 million is fully under or another way we like to say, the manager may elect to invest assets on sole and absolute discretion. So you, as the managing partner, have full control over what this is invested in, as a managing partner should. The charity is just happy that they're 99% ownership. So, because what they know at some point in time, not exactly sure when, because the documents can be written up to be, hey, I'm going to pay you in 5 years, I'm going to pay you out in 35 years. Who knows? Or somewhere in between. Because as the managing partner, I may need to take this money and do a little something with it. What can you do as the managing partner? Well, real estate, equity, bonds, interest yield. So there's a lot of things you can do. One of the other things, you can make distributions to the members. Multi-member LLC. Well, who's one of the members? I'm one of the members. And if I wanted to, the manager so they can make distributions, but distributions would be taxable. But the managing member can take a tax-free loan as compensation, but the loan must eventually, I should have made this bigger because this is a key word. The loan must eventually be paid back. So, Kelvin, what are you saying? What I'm saying, this $2 million that's sitting here in this charitable LLC, you could pay yourself $200,000 for the next 10 years and not pay any taxes on it and be 1,000% legal, with one caveat, which is eventually you owe this charity $2 million. Some way, somehow, they got to get paid. All right. So what I don't have in here is what people typically do. Let me just say, oh yeah, that's this last page. We're wrapping up. What people typically do in this situation, if they're going to pay themselves a salary, you don't have to. You can just take the money and invest it in that sort of stuff. But again, let's be real. At the end of the day, we're doing all this so we can benefit. What most people do to satisfy this requirement, can anybody guess? Can anybody guess? I've been talking about it all day. They buy a $2 million life insurance policy on themselves and they make the charity the beneficiary. So, like I said, eventually it has to be paid. So eventually you're going to get paid because I doubt if I'm going to live forever. So, it could be a $2 million term policy, but you just got to make sure you pass away within the term, or it could be a $2 million cash value policy, which means you can build up even more cash. And even after you spend all the cash inside it, the charity is going to get $2 million. And hey, you can pay the premiums from the $2 million that you have sitting here. So I'm going to wrap it up there. Again, I know this was kind of super, super high level, but I think hopefully I broke it down enough. And this is what I'll close out to say. One of the beauties of what I do is I get to introduce people to tools that can help them. Maybe it's not this complex. Maybe some of you, it is this complex, that you can utilize to 3 to 5x your wealth or your financial standing. That's what I'm all about. The information is out here. The strategies are out here. People are using it. People are doing this every day. Some of you may remember the transaction that happened between Bill Gates and Warren Buffett, that there was a big hullabaloo. Guess what they used? A charitable LLC. They're hiding, it's hidden in plain sight, but nobody's explaining why. Why is this such an issue? Well, because these people are doing this. So I hope I broke down the concept well enough so you understand. None of this stuff is really hard to understand, difficult. It's just that it's just information we don't have. So I would love to speak to any and everyone who is interested in maximizing their wealth potential. Maybe it's a charitable LLC. Maybe it's something as simple as a solo 401k, which I talked about when I first was here. But the tools are there. I want to make sure our community has the knowledge, has the understanding to execute these so that we can, carry out some of these transactions that, the wealthiest 1 or 2% are, because it's not an issue of them being smarter than us. It's really just they have access to information that we don't have access to. All right. So with that, I know I'm over time. I'm going to go ahead and end it there. And I'm here for any questions. And maybe while we're doing that, I'm going to go ahead and stop sharing and see. Do I'm not sure if you still have my information that we're going to share with the group. We could put into the chat. Okay.
Yep, I'm going to
So,
have that all, and it's also going to be in the email. So I'll have
okay,
part
great,
one,
great,
part
great.
two in this, and then your contact information.
Awesome, awesome. So, any questions, comments? You guys like the Charitable LLC? You don't like it? Am I the only one who likes it?
It's interesting because the charity, as you say, has to be a mature charity. So it can't be one like a 501c that's created. It has to obviously have some stipulations. So what is the benefit for them to be able to have this, to go into this partnership?
Great question. The benefit for them is, like it says, they know eventually, and I think that's again why some of the reputable ones are, good to utilize. But again, I would look at some of obviously, like, churches are charities, and we have some, I don't know what I'm not Southern Baptist. I don't know why that's coming to my mind, but Southern Baptist, Church of God in Christ. We got churches that have been around for a while, but we also have, I can't think of any right off the top of my head, but we have other charities within our community that have been around. So they're going to vet the charity. So if it's been a long-standing charity, or maybe it is a charity that you've known for, hey, let's look at that. But to answer your question, the benefit is just like a church or anyone else. They know, hey, eventually we're going to get $2 million. And we have, that's where these endowments and things like that come from. because people are leaving money to these charities that they want to carry out a benefit that they want to carry out a benefit or a cause that they believe in sometime after their passing. So the benefit to the charity is eventually you're going to be getting $2 million. So you're not getting it right now, but would you rather wait for $2 million, or you rather me go to another charity?
That's true.
So
So when
$2
you
million
solicit
is
them,
2 million.
that's that they have understood like this is an eventual payout at some point in time.
This
It's
is the
not
eventual payout
guaranteed.
at some
They're
point in
not
time.
putting it on their, on their book as something that they
Right,
can
right.
count on, but they're just stockpiling this as potential revenue for the charity.
Right. And they can put it, because again, the contract can be written in so many ways. So let's say there's a situation where it's like, hey, I'm going to invest this money in something more definitive, like an annuity or something where I know I'm getting, I don't know, 5%.
Mhm.
So then I could literally say, so okay, how long is it going to take this $2 million to turn into 4 million? Let's say, well, let's say I'm going to get 10%, because then I know my $2 million is going to turn to 4 million in about 7 years. So I'll say I'm going to pay you $2 million in 8 years. Um, you get to, I mean, so now we both got to wait 8 years, but I know, rule of 72. Um, 72 divided by 10 is 7.2 years. So that money will have doubled in 7.2 years. You get your money, I get mine. But again, let's be real.
Right.
If
So
it's
it's
$2
just
million
contractually,
on my
however it's written.
business, yeah, it's very easy for me to say, hey, let me take this $2 million, pay me, because I'm the one who did the work to get the money, and just go out and get a life insurance policy for $2 million and make the charity a beneficiary. There's plenty of churches that are beneficiaries of life insurance policies. Um, charities, it happens all the time. People sign over their homes, they sign over their life insurance policy. It's standard operating procedure for these charities. This is where their money is coming from.
Yeah. See, I would never have known that at
Yeah,
all.
yeah. So
That's really interesting. Miss Patrice says, thanks for all the information. Always have to shake my head at the way rich folks maintain their wealth. And the system is stacked against the non-rich. Right, exactly. Because you don't know what you don't know and you're never exposed to it. It's almost like a 1-2 punch. If you don't have the money, no one's going to share the information. And when you do, it's like there's all the vultures come out and they just want to just give you what is beneficial for them. So it's a very tenuous situation when trying to build wealth if you're not coming from it, because some of this is like, if you just, your dad did it, then he's going to show you how to do it, and this is kind of like a family thing. But if you don't and you're trying to build it independently, I think these are the roadblocks that come into play, because you really don't know. And some of these things, they take time to understand. They're not just really intuitive enough to be like, oh, this makes sense and I can just go ahead and do them, and they're not readily available to you either.
yeah, they're not. I say they're not intuitive, but again, I'm just blown away about the concepts. Aren't hard to understand. It's
Yeah, yeah,
just
they're
it's
simplistic.
no one. It's yeah. If
They're,
like
they're
if
readily
nobody,
available.
it's not hard to ride a bike. But if nobody taught you how to ride a bike, you'd be 50 years old and you couldn't ride a bike.
Yeah, very good analogy. Yeah,
Yeah,
I think
so
these
you
are some
once
of
you
those
ride
things.
it, it's like, oh, I could do wheelies, and I haven't ridden a bike for 20 years. I still know how to ride a bike.
That you do.
So yeah, but again, I want to just give a thanks again to the 10K project of just recognizing these are the kind of conversations that we need to start having, because again, none of this stuff is hard. The wealthy, and I'm an insider now, so what I'm telling you, it's not about intellect. It's just having access to information, and once you get the access to the information, it's about the education. Let's understand how it works. Let's look at, if it seems like there's an opportunity where you can leverage this. Hey, I have a friend and colleague. She purchased a house some years ago in Brooklyn. Couple 100,000, but it just so happened, 10 years later, it was right down the street from where they bought the Barclays Center.
Oh my.
That house is worth
Yeah.
$2.5 million.
Crazy.
Yeah, I need to talk to you about a charitable LLC.
Yeah, like
I
you
mean,
need to figure that out real quick.
yeah,
Yes.
let's connect the dots. Let's not make this harder than it needs to be. You
Mhm.
need that money. We don't. Hey, is there a charity out there you like? Let's get them vetted. Let's get 2 or 3 of them. Somebody on the list gonna make the cut. And then you do your thing and you ride off in the sunset with your 2.5 million, get you, pay your little premium on a $2 million policy, which is going to be a drop in a bucket compared to what you're making. And life is happy for everybody. So yeah, so and this is kind of my area of focus, is to get this information out, but also, as I said, wealth strategist, wealth advisor, understanding the strategy. What can we put into place in your situation? Because that's really what it's all about. All this stuff is great. If you have 5, I'm sure there's some people. I saw Patrice on there. She might have 5 to 10 million in assets. I'm not sure. I've been talking to her about some other things. So we're in the ballpark a lot
Yeah.
of times.
I
We're
think
in the
it's also
ballpark.
good
We're
to
not.
know
This is
before you
not
do, like
far
I said,
removed from what we got
this is
going
where
on.
you go. This is again, as a strategy, doesn't mean that you're implementing immediately. A strategy is telling you the elements you need as the prerequisites to get to that part. So there are a
Exactly.
lot of things that you need to do and be conscientious. So it's not just like, oh, I'm just making money. You're making money with an intent. And then like, okay, I need to hit this benchmark to do these kind of things. So I think it's always good to know what you need to before you even begin.
Yeah, yeah. And then, like everything else, is layers or a level or it's a phase, just like I showed earlier.
Mhm.
Maybe see, and this is where I come in with the integrated asset strategy. Maybe we put some other things in place. Let's say you're doing real estate. We'll just say that because it's simple. Maybe we put some other strategies that we already talked about: solar 401k, private family foundation, IUL, things like that, crowdfunding, what have you, in place, so that maybe right now you're on track to have $1 million in 5 years in net worth. Well, if you use some of these other strategies, I'm going to 3 to 5x that. So now in that same year, now you're at 5 million. Now we can execute
See,
plan
that's
B.
mhm.
So that's really what it's all about. Let's maximize what we can do now so that we can get to that next level where we can get into the door and make even more money, because that's what the wealthy has mastered, which is primarily understanding their money needs to make them money.
Absolutely.
And once we're getting there, but the sooner we can get there where our money is making us money to get us to one level, and now we can have more of our money making us more money.
That's it. I love that. I keep always referencing that first slide. I really enjoyed that slide because I'm like, that's the breakdown. You really feel like, sometimes you can maneuver back and forth, and it is bilateral in the sense sometimes you
Mm-hmm.
got to go back to go
Yep.
forward, but
Mm-hmm.
it does make the progression make sense. It's just like, okay, there is a starting point, and then there's things in the middle that can make these things work better for you. And again, you can participate at different times and different levels or simultaneously. I did like the fact that you just brought up like, oh, if you do these things together, it'll push you to that level so that you can maximize moving, expedite your move to the next level. So I really appreciate your time, and all of the sessions have been quite informative. We go through them a lot. I know I've watched the second replay like twice already. So it
Awesome.
just
Awesome.
takes the time to get it into the brain and to make it work. But thank you so much for your time and
No
the
problem.
information
No
you were able to
problem.
share. And if you guys have any questions, please feel free to ask. And like I said, I'll be sending out the replay, and I'll make sure to include all the information, including the parts 1 and 2 for you. Okay.
Awesome. 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 All right. Well, thank everyone again. Thank for the opportunity. I I do need to follow up with you guys because I need to. I don't know if there's going to be time on the schedule, but I
Mhm.
need to come back and update you on my crowdfunding offering. We've made some updates to that, so I want to come back and repitch that to the group. So
All right.
maybe we
I will
can get
make
a
sure we
schedule
let
for
you know.
that as well.
All right then. Well, thank you
Awesome.
everyone and have a wonderful day. We're going to be having the Bet on Black pitch tomorrow. I put a teaser into the Facebook group. So we're having an AI smart homes individual, and it's a returning founder coming to share his new and latest project. So make sure you join us tomorrow at 8 o'clock for that, and we will see you tomorrow. Good night.
Good night.